Good morning, everyone. Welcome to a new week and to another edition of the Vetiva Breakfast Meeting, brought to you by Vetiva Capital Management in partnership with Frontier Africa Reports. Today is Monday, the 31st of May, and on our agenda, we'll be having a rundown of the local equity and fixed income markets, as well as a summary of last week's activity in the Ghanaian capital markets from our partners at IC Securities. And finally, we'll have some key headlines from our partners at Frontier Africa Reports. Before we hear from our speakers, I'd like to remind everyone that this meeting is being broadcast on Facebook and is also being recorded and may be shared with third parties. The presentation is scheduled to hold for 30 minutes, and that includes Q&A. However, if due to time constraints, we're unable to answer all of the questions we may have today, please feel free to forward any questions you have to us at research@vetiva.com, and we'll get back to you as quickly as possible. So today we'll start with a rundown of the equities market from our global equity desk, headed by Shion Oshoma. Good morning, Shion.
Good morning, Joshua, and good morning, everyone. Thanks for joining us. So we'll be reviewing performance of the BRVM and the Nigerian Stock Exchange in the last trading session as well as last week. And we'll also be giving our outlook for the week. So starting off at BRVM, the composite index saw red in the last session as the index closed 48 basis points lower. Though we saw a significant improvement in volume, about 714%, volume traded on the back of over 1 million units of trade in FTI. Value was, however, lower in the session as it declined 23%. Just like we've seen for most days in the month of May, market breadth was positive with 21 gainers and 10 losers. Still in BRVM, gainers on the day include Bank of Africa, Sode, as well as Nestle Cote d'Ivoire. However, a 10.6% loss in Onatel at market close, as well as Aura Group and Safka, pull the index lower in that session. Looking at the weekly performance, the index ended the week 2.9% higher, while all sectors also closed the week up, led by 11.88% gain in the industrial index. So for us going into the new week, we expect a largely positive outlook as market sentiment remains healthy in the large cap names. We believe we should see pockets of profit taking, but overall, market should remain largely in the green in the BRVM for the week we're about to go into. So moving quickly to Nigeria, finally on the 10th attempt, the ASI closed up to end the last trading session of the week, 56 bips higher. Positive close in some heavyweight counters supported these green close as MTN, Nigerian Breweries, Seplat, and Zenith all ended the session higher. And we noticed that the biggest contributor to the gain was actually Dangote Cement, as the market was actually heading for a negative close before we saw a 417 basis point upward movement in Dangote. That was a move which moved from 204 naira, which it closed the previous day, to close 212 naira 50 kobo, which was just before the close of market. Speaking to activity level in the session was significantly higher, with volume up by 7%, while value traded inched up 175%, which is largely on the back of crosses that we saw in some of the market heavyweights, and which was also actually across sectors. We saw crosses in GTB, that was a 40 million. Then we saw in Nestle, we also saw in Seplat as well. Market was quiet outside those crosses, those cross trades, pretty much. The banking sector dominated as that the session has accounted for over 50% of the traded turnover. Even as all sectors also closed in the green, basically led by the insurance sub sector. Quickly to market breadth, that also ended the session positive after a long while as 22 stocks gained with just 15 decliners. So looking at a wrap up for the week, the index closed down 18 basis points, though the market closed up on Friday. For the week, the index closed down 18 bips, which is largely due to losses in previous session. Insurance and the oil and gas sector posted positive week-on-week gain, while the other sectors couldn't recover from losses earlier in the week, just like the broader market as well. Broader index could also not recover. So going into the week, we'll likely see a positive start following Friday's more poor close, as investors, we believe investors will begin to cherry pick in the market again. However, I would believe this will be on thin volumes, as we still see a few headwinds as well as better than expected, as well as because of the rates we're seeing in the fixed income market. So coupled with these two, we still see the market slightly, the sentiment not to have improved fully, but we believe in the first two sessions of the week we should see some positive, but slightly on thin volume. So we'll continue to watch, and we believe some of the names which we like we've also mentioned include a few in the banks. We like GT and Zenith. We also believe names like MTN as well, where investors should be putting their funds. Thank you. That'll be it for the equities market. Have a nice day.
Thank you very much, John. Now, next we'll hear from our fixed income trader, Omorigi, on the FI and currency market. Good morning, Omorigi.
Good morning, Joshua. Good morning, everybody. I'll be taking a recap of Friday's activities for the fixed income market. I'll start with the money market. System is still very liquid. Money market opened about 252 billion negative on Friday. After we adjusted for repos and almost sales of about 41 billion, market was about 448.5 billion negative. This was a significant decline from Thursday's opening figures of 74 billion negative. This extremely tight system liquidity on Friday, coupled with the increased funding pressure as players had to make provision for the FS retail auction that happened on Friday, caused interbank rate to tighten by over 500 basis points to trade at around 18% levels from the 13% levels recorded on Thursday. We expect the money market to trade at lower levels today in the absence of any significant funding need in the market. Moving on to the Nigerian FX market, the parallel market remained stable to trade at 495 naira to $1, while the earning window trade at the hour 430 naira to $1, closing at 412 naira to $1. That is about one naira depreciation from where it closed on Thursday, which was 411 naira to $1. And this was largely due to the significant decline in the earning industry turnover, as it declined by over 55.5% to close at $156.06 million on Friday from the $350.65 million recorded on Thursday. The oil market remained relatively flat on Sunday as the price of Brent crude gained marginally to close at $68.97, representing an increase of 0.36%, while the Nigeria External Reserve declined by 0.06% on Thursday to close at $34.26 billion. This basically means that Nigeria has lost over $1 billion in little over a month. We believe that the Naira will continue to hover around these levels in the interim, in the absence of any significant inflow of FX into the system. Moving on to the Nigerian Treasury-based market, the T-based market opened on a quiet note on Friday, with selling interest sustained on the OMO curve due to the extremely low system liquidity. As the trading session progressed, we witnessed significant buy interest on the newly issued one-year NTB maturity, as some market players tried to feed their immense demand at the auction. Some trades were consummated on the newly issued one-year NTB at around 9.2% levels. We believe that the T-based market will also trade actively today as players continue to feed their lost auction bids in the secondary market. I'll conclude with the Nigerian bonds market. The bonds market traded on a quiet note during the early hours of Friday's trading session. As the trading session progressed, we witnessed demand across the mid to long end of the curve, especially on the 2034, 2035, 2045, and the 2049 maturities. These demands were met with limited offers in the market, and as such, an interplay of Friday activities resulted in an average decline of 5 basis points in rates to close the week. We believe that the moderation that was witnessed on Friday will persist today as the lack of offers continue to play out in the Nigerian bonds market. That concludes it for fixed income. Thank you very much.
Thank you very much, Omar, again. Next, we'll go to our partners at FCCKP on a breakdown of the Ghanaian capital market. Good morning to Daniel and Jonathan.
Good morning to you. I'll start with government treasury bill space. The government of Ghana exceeded its targets at Friday's treasury bill auction as it raised approximately 1.82 billion Ghana cedis, which was 1.5 times the target amount for 91-day, 182-day, and 364-day bills. The yield for the 91-day bill was relatively stable from the preceding auction, while the 182-day and 364-day bills dropped by 4 basis points and 7 basis points respectively. We linked the increased bid cover ratio to improved liquidity on the market as no treasury bond issuance occurred during the week. On the local currency bond market, activity was seen across the curve on Friday. Jan 27 maturity was of particular interest, with large volumes trading in the session where it opened at 18.90% levels, but traded down to touch new lows of 18.75 near session close. 26 were also seen trading around 18.8% levels on the day. At the front end and the back end of the curve, Jan 23 and August 39 maturities dealt at 17.05 and 19.8% respectively. We expect to see a similar session from Friday's close to cap off the month of May. On the Eurobond space, the 10-year US Treasury yield started the week at 1.60%, declined 2 basis points midweek, and closed the week above 1%. Ghana bonds saw significant activity across the curve last week as the zero coupon bond traded in decent clips, though the yield didn't move. 42s, 49s, and 51 maturities traded two-way in good sizes across the week, with 49 staying below 9%. We expect similar narrative today. Thank you very much.
Good morning. Market activity was lively during last week's trading session, backed by block trading activities in MTN Ghana and CAL, with a deal contributing 85.38% of the 90.3 million traded value. The Ghana Stock Exchange Composite Index continued to make steady gains, closing with a year-to-date return of 24.7% after recording 7 gainers and a loser for the week under review. SCB topped the gainers chart as the stock advanced by 30 pesos to 18.50 Ghana cedis. This was followed by FML, Goal, and SocGen, which advanced by 6 pesos, 4 pesos, and 3 pesos to close at 1 cedi 32 pesos, 1 cedi 55 pesos, and 87 pesos respectively. Cow was the sole lag on the bus as the stock lost 7 pesos to close at 73 pesos. We are likely to see a similar session for this week with sustained buying interest in FML, GCB, and Societe Generale. Thank you very much.
Thank you very much for that. Next, we'll hear from Temple Ashaju, our partner from Frontier Africa Reports. Good morning, Temple.
Good morning, listeners, and welcome to a new week. Taking off from the eastern part of Africa as usual, foreign banks' volume of businesses in Kenya depreciated to $3.4 billion as at last year. That's a report that was released over the weekend, and that's a decline from $4.67 billion as of 2019. We understand that the decrease is largely due to a slowdown in economic activities coupled with the effects of the COVID-19 pandemic. In Ethiopia, IFAD and EU, that's the European Union, are collaborating to inject some 26.5 million euros debt relief in the rural financial institutions. They're basically to help protect jobs and safeguard livelihoods, especially for those in the northern parts of the country that have been subjected to wars and conflicts in recent times, those close to the Tigray regions and of course the Amharic speaking part of the country, then of course some part of the southern part of the country. This will help provide some new lines of credit to the agriculture SMEs and the farmers in that area. We know that we just spoke about Ghana, and of course everyone's waiting for the briefing of their MPC meeting, which will come up at about 11 a.m. This morning. We understand that Ghana is projected by Bloomberg, one of the 8 countries that is expected to leave their rates unchanged, 14.5% for MPR at the moment. Of course, that's projection is basically still due to the fact that inflation has been slowing down. It's at 8.5% or thereabouts as at April, and they do expect that that will take a bit of a backbone at this point in time. And the Democratic Republic of Congo has just received or is to receive some $1.5 billion funding from IMF. Sudan says it is ready now for business. We all know that from the meeting, the France-Africa summit that held a couple of weeks back, the France and a couple of other countries have indicated support to reduce their debt burden, even as Emmanuel Macron, the president of France, is calling on other G20 Paris Club members to also help lessen or lighten the burden of debts on Sudan. All of that seem to have started taking shape and giving some positive impacts on Sudan at the moment. They're waiting for Kuwait and China to also find a way to help reduce their $6.2 billion combined debt to these two countries. But at the moment, it looks like it is one considerable destination for investment at this point in time. Of course, finally, more companies started considering listing on stock exchanges in Egypt. We understand that United Media Services is getting some 20 to 30% of its stake listed on EGX20 by in a few years' time. South Africa just welcomed SA Breweries Zenzele Kabil on their empowerment segments of the Johannesburg Stock Exchange. And we do hope that such developments will rub off on Nigeria and a couple of other West African markets going forward. These are the headlines we have for you this Monday morning. Thank you for listening.
Thank you very much, Temple. We've now reached the Q&A portion of the meeting. If you have a question and would like to speak, you can raise your hand and give you permission to ask a question. If you're joining us on Facebook, you can also leave a comment and we will answer the questions there. We already have a question in the Q&A box, and I'll read that out now so that you can answer it. The question is from an anonymous attendee. It says, can you talk a bit on the likely scenarios for the market based on the current insecurity in the country and the federal government response? So I'll pass this on to Global Equities trader. So please go ahead.
Yeah, morning, Josh, and thanks for the question, Anonymous. I think largely what you're looking at is the investors' sentiment around the insecurity challenges and how the government so far has responded. I think just on the broader sense, market doesn't like uncertainty, which obviously insecurity falls under such. With insecurity, there are so many things just don't. There's a little bit of uncertainty all over. So market will obviously be taking a look at such. Though I would believe the level of passive response that we have seen to the equities market largely might be more linked to some other headwinds, like maybe the FX challenge, as well as maybe a bit of some company specific, as well as the FI rate. We cannot rule out the security challenge to also be one of them. But at the moment, we're probably not seeing the full weight of it on on the equities market. Maybe we have not seen the full weight of the insecurity, but we are beginning to feel that pinch. It's negative. So, like I mentioned, it's negative, and with such, investors will always price that into their decision. Put some level of discount maybe their pricing or their outlook for such market. Um, and again, for to be company specific, we believe it will it affect companies as well, because it cannot function. Companies won't be able to function optimally in that region. So you take a look of maybe agric companies. You're not seeing people are not able to plant. You're seeing insurgents saying, "Oh, people have to pay, or farmers have to pay before they're able to plant or to farm and all that." So you're obviously going to see that affect the companies in the agri, we believe consumer goods and industrial sector as well, because there won't be that much development going on. So you're not seeing maybe cement companies being demanded for and all that. But we just believe those would be the likely names, those would be the likely sectors that will be affected. And in terms of government response, I probably won't be able to say much, because, but from what we can see, government has seem to be doing the best it can do. But and like I said, I probably won't be able to say much in that regards. But generally, insecurity is a major challenge for any economy, for any country, and it will definitely affect markets negatively. I'm sure even if you look at the fixed income market, a few of the investors will also be it local or foreign investors, will also be pricing that into how the sort of rates they will be looking at or demanding for. But generally, it affects everything negatively. So I don't know if any fixed income, I also want to put in any sort of comments there.
Okay, thank you, Sean. Thank you for the question as well. So basically, you touched on it. Insecurity is a negative for markets. We'll see more of. We can all see that where inflation is today is as a result of some of the pass-through effect of insecurity, in addition to the FX challenges we currently have in the country. As this continues to go on, we'll definitely again see how this filters into macro conditions, i.e. inflation, i.e. lack of interest from foreign investors and attendant impact on FX, basically on the country.
and then you start to see the pricing again in market. So again, as if the insecurity continues strongly and nothing is done about it to moderate it, it starts to affect food, it starts to affect movement of things across the country. And when this definitely comes into the market, we start to see investors pricing in the yield impact. The good thing, which again, not necessarily good thing, the if I may use the word, what softens the impact is that the investment space is not largely so much of foreign investment anymore that responds to strong macro movement. More of local participants are doing stronger volumes in recent times. And again, as long as you have liquidity, you need to push it into something. So that is just the enjoyment the federal government or the DMO or the CBN is currently leveraging and helping them to manage borrowing costs and yield levels in the market. But overall, if this continues, we'll see strong impact again on inflation. We'll see strong impact on FX interest, and definitely the whole macro environment will become extremely challenged. Unemployment, we know the host of factors or things that come into play when insecurities at the forefront. So we would expect that the government will continue to try to do the best they can. It's the question then becomes, what is the best that they can to support the economy? But market will continue to look out, and I'm sure market will price in strong impact of this even before they materialize if things don't get, controlled as quickly as possible. I think that's just what we can add from this end. Thank you.
Thank you very much to Phil and Double for those answers. If you have any other questions, you can still leave them in the comment section or raise your hand if you prefer to speak. It appears we don't have any more questions, which means we've reached the end of today's meeting. Thank you very much for joining us. We hope that you enjoy the rest of your day, and we hope that you join us again tomorrow for another edition of the Vetiva Breakfast Meeting. Do have a good day. Goodbye.